So good morning and good evening to everyone who have joined us from India. Honorable Ambassador Sripriya Ranganathan, Deputy Chief of Mission, Embassy of India, Washington, D.C. Mr. Pranav Sayta, Chairman, FICCI Taxation Committee, Partner and National Leader, International Tax and Taxation Transaction Services, EY. Mr. Uday Primpekar, National Leader, E&Y India. Dr. Ravi Kota, Minister Economics, Embassy of India, Washington, D.C. Mr. Praveen Jain, Chairman, Washington, D.C. ICAI Chapter. Members from Indian industry and US industry. Ladies and gentlemen, thank you for joining us today and welcome to the virtual session on Union Budget 2023 Insights for India and US Businesses. Union Budget is almost a mega event celebrated on 1st of February every year with lot of hope, expectations, and anticipation. It combines the State of the Union, the country's annual results is announced in an AGM, and a vision for the next decade, all into one. Among all this, optimists and pessimists need to be satisfied, which is a very difficult balancing act for our finance minister. Today, we come together optimist for the year and the future, because with the Government of India budget finally showcased last week, the industry seems given it a positive thumbs up. Budget this year has attempted to touch every aspect of the economy with something for everyone, from enterprises to startups to individual taxpayers and farmers. India and US are natural partners, and this partnership has deepened and took on new heights with the Biden administration. We believe this budget also throws up huge opportunities for investors, especially in the areas like digitization, innovation, scaling, infrastructure growth, and green energy. Today's session is basically focused on key and relevant notifications of the budget and its implication for companies operating in India and US market. I look forward to hearing from our eminent speakers of their views on Indian budget 2023, the new landscape, and the prospect it presents. I wish everyone a meaningful session. Over next 1 hour, we'll be hearing from our speakers, and I request everyone to keep their mics on mute. That will allow us to hear the speakers uninterruptedly. Participants, please feel free to ask your questions during the Q&A, and I request everyone to post your questions using the chat box feature. Thank you. With this, I now invite Honorable Ambassador Sripriya Ranganathan, Deputy Chief of Mission, Embassy of India, Washington, D.C., to present her special remarks. Before that, let me say a few words of introduction. Madam Ambassador, prior to her arrival in Washington, D.C., she served as an ambassador of India to the Republic of Korea. In earlier overseas assignment, she served in Myanmar, Turkey, and Hong Kong. She has also served in various capacities in the Ministry of External Affairs as well as in the Ministry of Commerce and Industry. She also headed and led various other departments in multiple ministries in India. Thank you. With this, I welcome you, ma'am, and I request you to kindly present your special remarks. Thank you.
Thank you so much, Swapna. Good morning to representatives and members of the Federation of Indian Chamber of Commerce and Industry, the Institute of Chartered Accountants of India, participants from industry and other important stakeholders. We are here today to discuss the opportunities and incentives that have been created by our annual, by the most important annual exercise, the Union Budget, which not only impacts the domestic, economic and commercial landscape of India, but also paves the way for us to deepen and strengthen our partnership with our global partners, including and foremost amongst whom is the United States of America. I think we all appreciate and acknowledge that the economic ties between India and the USA are stronger than ever before. And this has, if you recall, this was acknowledged by Secretary Yellen when she had visited India back in November 2022. This is also corroborated by facts and figures. The US was India's largest trading partner in the last financial year, 2022. The year in which bilateral trade crossed the 100 billion mark and went far beyond to reach an impressive 119 billion. In the same year, the US also retained its spot as the second largest source of foreign direct investment into India, with a 18% share of our overall FDI. At the same time, many Indian companies are also investing heavily in the US and are adding significant value. A CII study of 2020 found that the total value of investments made by 155 Indian companies in the US has crossed $22 billion, with 77% of these companies planning to make more investments in the USA. I think this is, of course, a little dated. This is data of 2 years ago, 3 years ago now. So I'm sure that much more has happened in the intervening period. Our cooperation under bilateral and multilateral dialogues, like the Trade Policy Forum, the Economic and Financial Partnership Dialogue, the India-US CEO Forum, the Strategic Clean Energy Partnership, the Initiative for Critical and Emerging Technologies, which was launched just last week when NSA Global was in town, I2U2 Quad, these are all just elements of what we have forged as part of our economic and commercial partnership. Turning to the budget, I would like to emphasize that the budget focuses on Saptarishi, or the seven priorities: green growth, infrastructure and investment, last mile connectivity, financial sector, youth power, unleashing potential, and inclusive development. With its comprehensive scope and roadmap for economic growth for the next 25 years, Amrit Kal, based on these key seven pillars, India's union budget for this year is a harbinger of strengthening the multifarious complementarities between the two countries. This has been hailed from all quarters since it has a very unusual combination of key elements: capex boost, consumption boost, and fiscal prudence. This is, I would say, an almost unimaginable combination, that if we pull this off, this will really take us to a completely different level in terms of our economic growth and development. Friends, as we know, both India and the US are leaders in the area of green growth and the fight against climate change. With its green push, the budget for the year offers considerable incentives for B2B partnerships and spurring investments for US-based stakeholders. Some of these main incentives include priority investment worth $4.2 billion for meeting net zero emission goals, viability gap funding in battery storage capacity, investment in the interstate transmission system and grid integration for renewable energy, $2.4 billion for the National Green Hydrogen Mission. That is just part of a long list. We have all heard the maxim that infrastructure is the sine qua non for development. This budget makes an unwavering commitment to investing in multimodal greenfield and brownfield infrastructure assets. Regional air transport projects will not only enhance connectivity, but also offer investment avenues for domestic and global stakeholders. The government has also committed $1.25 billion for investments in an urban infrastructure development fund that will crowd in private investments in India's lucrative infrastructure sector that offers high returns. Turning to the financial sector, I would specifically like to highlight the announcements that have been made for GIFT City, which is an initiative that we are very excited about. A GIFT City delegation was also in the US a few months ago to talk to potential partners and investors in the US. The offshore economic zone has captured the imagination of global investors. And we are hopeful that important American financial institutions will also deepen their involvement in this project. This budget adds a few more gifts to GIFT City. The timeline for applying for tax incentives offered by GIFT City has been extended till March 2025. Provision for single window registration for various financial services, including GIFT City, RBI, SEBI, etc., has been made. A subsidiary of Exim Bank will be set up in GIFT City for providing capital for trade finance on easy terms. Foreign banks will be allowed to provide funding for M&As. Companies will now be allowed to set up data embassies in GIFT City. The focus on youth power means that the budget makes provision for turning India into a research and skilling hub. Among various other initiatives, it has also been decided to set up 3 centers of excellence for AI in top educational institutions. 100 labs will be set up in educational institutions to develop 5G-based app for EdTech, health tech, and agri-tech. I think this is something which many of our US partners will welcome. I have met a few companies recently which have been talking about exactly this, how they would like to use the human resource wealth in India to grow their business and to get a larger share of not only the Indian market but also the global market. To allow access to anonymized data for research and innovation, a national data governance policy is to be launched. These measures will throw open multiple avenues for cooperation between India and the US, including under the recently launched ICAI. For India to be a global hub for millets, an environment-friendly crop, and many of you would know that this is also the UN International Year for Millets. The Indian Institute of Millet Research in Hyderabad will act as a center of excellence for sharing best practices internationally. What's more, to unleash India's potential and to incentivize investments, a huge focus has been laid by this budget on improving the ease of doing business. Some of these measures include an extension in the timeline for availing income tax benefits for corporates and startups, setting up of a central data processing center for responding in a timely manner to corporate applications. KYC processes will be simplified, reduction in criminalization of compliance, decriminalization of compliances, funding for phase 3 of e-courts project for judicial efficiency, improving the governance of banks, creating an online portal for investors to reclaim their shares and unpaid dividends. Vivad Se Vishwas 2.0 will provide for the settlement of commercial and contractual disputes. And I am certain that these measures will further enhance investments from our global partners and especially the United States into India, which is, as it is, been on an ever-growing trajectory over the past few years. I'd like to end by saying that this budget has all the measures that are needed for India and the US economic and commercial partnership to reach greater heights, with international agencies dubbing India as a bright spot in a challenging global landscape. I would hope that our friends in the US make the most of the exciting opportunities that have been unveiled in this budget. And I would finally like to once again thank FICCI and the ICAI Washington, D.C. chapter for partnering with us in organizing this session. I look forward to the conversation. Thank you all so much.
Thank you, ma'am. Thank you for the very thoughtful remarks. And, thank you for sharing the, highlights of the budget and the opportunities for the India and the US industries to collaborate. Moving on to the next, I would like to now hand over the floor to Mr. Pranav Sayta and Mr. Uday Pimprekar to kindly, present us with the budget highlights and the implications of the, budget notifications. Just a brief introduction. Mr. Pranav is chairman of FICCI Taxation Committee and partner and national leader, International Tax and Transaction Services, E&Y India. He has played diverse roles in E&Y India and has been the national leader for the transaction tax practice. Mr. Uday is national leader in direct tax services, EY India. Mr. Uday has close to 20 years of experience in advising clients on various indirect tax legislations, including service tax, excise, customs, foreign trade policy, and value-added tax. Thank you for joining us today, sir, and over to you.
Thank you. Thank you so much, Swapna ji, and thank you, Sripriya ji, for the special remarks. Good morning to all the dignitaries as well as all the participants. Wish you a very good morning. Thank you for the opportunity to FICCI in particular for organizing this and giving us the opportunity to present. What we will try and do very quickly over the next maybe 30 minutes is between Uday and I, we will try and present the key budget proposals. And towards the end, then we'll be happy to take any questions from any of you. So moving on, what we would like to do today is start with the budget backdrop, including the economic survey, move on to the policy announcements in the budget, and then the key direct tax proposals, followed by indirect tax proposals, which my colleague Uday would take us through. As we all know, the budget came, the Indian budget, 1st February 23, came in the midst of a lot of global headwinds, as we are seeing all around us, with global monetary conditions tightening all through the world, high inflation, increasing interest rates by various central banks across the world, and also some skirmishes, especially, for example, in developed markets like UK. In the midst of all this, global growth forecasts have been slowing down. There is one bright spot, and glad to say and glad to see that India remains that bright spot, which is one of the fastest growing economies in the world. And there are several things which seem to be going for India when the budget came across. One is, while interest rates have been increasing in India, the pace of growth, the pace of increase in interest rates has been much lower in India versus some of the other markets. While global currencies have seen a severe beating vis-a-vis the dollar, rupee has relatively been much better off, and therefore in a relative sense has outperformed most of the other global currencies, although it admittedly did depreciate against the dollar. The consumer inflation in India, while certainly it has increased and it's beyond the band of comfort for the RBI governor, nonetheless, the increase in the rate of inflation again has been more tempered in India, probably thanks to the prudent macroeconomic policies that had been adopted over the last couple of years, even in the midst of the pandemic, where the kind of monetary and fiscal easing was far more moderate and tempered. The growth in the current environment has been driven primarily by structural underpinnings as we see it. One is significant investment expenditure from the government towards CapEx. And of course, contact services and private consumption has been picking up hugely. Very pleasantly, the government's fiscal revenue collections have been extremely buoyant, and that has really helped keeping the fiscal deficit in check as well. And that indeed comes as a breath of fresh air, particularly at a time when the government needed it most. The Indian government continues to focus on long-term levers to improve Indian growth environment from a structural perspective. So there have been significant incentives given for manufacturing, especially the PLI schemes, and probably Uday will touch upon it during his presentation as well, has been a huge success. And so has been the massive investment push for infrastructure and CapEx that the government has embarked upon over the last 1 year. India has been one of the leaders in digitalization and payment systems, particularly, and that has indeed stood it in very good stead relative to most other parts of the world. Decarbonization and energy security has been one of the key themes of the government, and that has also helped in reducing both the economic risks as well as the risks to the currency, and has created many new investment opportunities, as Sripriya ji also alluded to. India has taken over the G20 leadership and brings very high expectations from the country, especially at this point in time. The economic survey, if one looks at it, again shows a very strong macro story for India. The GDP growth has been projected for the year just to be completed in March 2023 to be 7%, which in the current environment particularly is supposed to be by far the highest in the world amongst any of the large economies. Fiscal management has been pretty prudent. So the fiscal budget deficit was 6.4%. The budgeted fiscal deficit was 6.4%. And as the finance minister announced, we all know that it has been maintained at that level. Very significant push in the capex as we see April to December of the current financial year, April 22 to December 22, which is for the financial year ended March 23, the first 9 months. So almost a 25% plus growth in capex and huge investments, which in turn are crowding in private sector capex as well, which indeed was much required. The external sector has seen a big negative trend thanks to the increase in the crude oil prices, commodity prices, fertilizer and food, and so on. Nonetheless, thanks to the huge forex reserves, the stability of the currency has been well maintained, and the central bank has really managed the forex reserves extremely well in the current environment. In terms of monetary policy, of late, there have been continuous increases in the central bank rates, indeed, as has been the case with most other central banks across the world. And while there has been significant increases in the interest rates, nonetheless, the fact still remains that relative to most other countries, it has been quite tempered. Success, as I said, of the PLI scheme has been a huge positive, and the future growth drivers continue to be: one is the capex and the physical as well as the digital infrastructure push, which the government continues to focus on, and significant focus on climate action within this particular country. So we are seeing today a very sound macro environment, 7% growth for financial year 23, very brisk growth expected for financial year 24 as well, backed by capital investments. The balance sheets of the entire financial sector, as well as most of the corporate sector, is extremely strong. And therefore, in terms of financial stability, the system seems extremely healthy, probably one of the best phases amongst the Indian corporate sector. The reforms undertaken on the technology digitalization front by the government has started paying very rich dividends, and are such scalable at population scale for India, which is huge. And the diversification of global supply chains, the geopolitics in the globe that we are seeing today, is also significantly helping the Indian sector, corporate sector, as we see it. The budget, in the midst of all this, has made very significant announcements in terms of further continuity on the growth agenda. The budget has spoken of a fiscal deficit budgeted for financial year ended March 24 at 5.9%, which is a good 0.5% lower than the financial year 23 fiscal deficit of 6.4%, which clearly shows a good macro stable environment. The infrastructure and capex push has been continued. So we are talking of a capital investment outlay projected to go up by 33% on top of a huge capex growth for financial year 23 itself, so on top of a large base, which means crowding in of huge private sector investments. Also, India needed a big push from a structural infrastructure perspective, for the simple reason that a great deal of the competitiveness of Indian industry can be enhanced by improving the Indian infrastructure, and the multiplier effect from a growth standpoint economically can be very significant for a country like India. While we are told that the capital investment outlay will increase by 33%, if one further looks at the support to the state governments, which the center will provide, the actual increase in the capex is as high as 37.4% projected for financial year 24, which is unprecedented. And the total capex now will stand at 3.3% of GDP, which again is the first amongst any year in the past. What we are seeing also, which should not get missed, amongst all this, is that while fiscal deficit is being lowered to 5.9%, despite that, capex is increasing by almost 37.4%, as I said, which means it's a very prudent way of managing the fisc. The fact also is that revenue expenditure has been projected to increase only by 1.2%. That's what ensures that the fiscal deficit is maintained at 5.9 despite the huge increase in capex. So very prudent spending on the revenue side is what was always the need of the hour, and that's what this budget seeks to achieve. As has been again said, the quality of the capital outlay is also very significant to notice. Capital outlay for the year ended March 24 is projected to be almost 18.6% of the total expenditure of the government. And of that 18.6%, the non-defense capex capital outlay is going to be 15%. The defense capital outlay remains static at 3.6%. So the non-defense capital outlay goes up from almost 11% in financial year 23 to 15% plus in financial year 24. So the quality of the capital outlay is also significantly better. Defense capital outlay stays the same as financial year 23, which is 3.6%, which means thereby that the capex that the government is planning will really ensure better infrastructure for industry and for citizens, and in turn make Indian industry far more competitive from a global environment standpoint, which is indeed an extremely welcome step. Also, if we look at the nominal growth that the budget has projected for financial year 24, it is 10.5%. Now, mind well, for financial year 23, the nominal growth has been 15.5%. And in financial year 24, it is being projected at a very prudent 10.5%. So I would feel, again, no overestimations here. And it seems that it's a very prudent estimation of the nominal growth. A nominal growth of 10.5% will mean a projected real growth of probably 5 to 5.5%, which is much lower than the current year's expected growth of 7%. And the projected growth by most international agencies as well as the economic survey of 6.5%. So it's a very, very conservative estimate of the growth as well. And so also in terms of the buoyancy of the market. The budget also significantly increases attractiveness of IFSC, the gift city, as was also mentioned by Sripriya ji. And certainly that again comes as an extremely welcome step. In terms of ease of doing business, the government has taken considerable further strides in continuation of its policy. We now have a common business identifier PAN, a unified filing process, and also significant push towards promotion of green energy, as was also alluded to. All in all, we feel that the budget is really growth-oriented, significant focus on technology and digitization. Sripriya ji did mention about the AI COEs. There is significant push towards private consumption, urbanization, capital expenditure, infrastructure spending. Again, the budget spells stability, no minor tinkering, targeted effective spending. As I said, very little growth in revenue expenditure. It focuses a lot on trust, fairness, and transparency, as we will see as we go along over the next few slides. Generally, the budget has been very inclusive in its scope, in as much as it gives something to every constituency in the economy, and by and large is very futuristic and macro conservative, as I would put it. Takes full advantage of the Indian demographics as well. As we know, Indian demographics is a big advantage, with the working age population growing at a very fast clip and probably going to be keeping on increasing for the next several years. Moving on further, from the direct tax side, there are no change in corporate tax rates. They are already very, very competitive and they continue to be maintained. So stability and continuity there. So also for individual taxpayers, largely continuity and stability. But if an individual taxpayer opts for a concessional tax rate regime, there are further reliefs, thus putting more money in the hands of the middle class to enable them to spend even more and make the tax rates in India really competitive, give also a consumption boost to the domestic sector, especially at a time when exports may likely suffer and may not contribute too much to growth because of the global headwinds that we are seeing all across. Moving on further, one of the tax provisions that has been expanded this year is the angel tax provision. The angel tax or the gift tax provision was or is rather currently targeted towards closely held companies. If a closely held company receives subscription towards shares from resident investors, we are told that if the subscription amount is more than the value of the share, the excess can be deemed to be income. Now we are told that the subscription, even if it is received from non-resident investors, would also attract this provision. Also, we are told that market-linked debentures and gains arising on transfer, redemption, or maturity of market-linked debentures will now be taxed as a deemed short-term capital gain rather than taxable at the long-term capital gains methodology and rates. Of course, there are certain misses in the budget drafting, which might still mean that this gain may be taxed at 10% unless those are corrected in due course. But yes, that's the provision in respect of market-linked debentures. Moving on, the budget also talks about taxing any capital gain on sale of intangibles which are self-generated, either to except for specified intangibles which were deemed to have a cost of nil. Other intangibles may not have been taxed under the capital gain provisions. Now we are told transfer of any intangible asset which is self-generated, cost will be deemed zero and will be taxable under capital gains. So also with any other rights. Online gaming is sought to be now taxed, taxable at 30% on the net winnings, and there would be withholding tax on the payments that are made to the winners, either at the time of payment or at the end of the year, whichever is earlier. Again, the withholding tax would be deducted at 30%. Very quickly, for non-resident service providers in the oil extraction and production sector and in the turnkey power project sector, we are told that any carried forward losses from earlier years may not be allowed to be set off if the taxpayer chooses to go for the presumptive tax regime. Under the presumptive tax regime, 10% of the overall turnover or gross receipts is taxed as a deemed income, and that the taxpayer need not maintain books of accounts and so on and so forth. So this is a deemed taxation entirely at the option of non-resident taxpayers. For REITs and InvITs, which is business trusts, there were certain situations where there was double non-taxation, where, for example, if debt repayment or debt taken up by the REIT or InvIT was distributed to the unit holders, neither the REIT InvIT paid the tax nor the unit holders. Now we are told that any amount received by unit holders in respect of such debt repayment distributions will be regarded as other income and taxed as regular income under the head income from other sources. In terms of tax incentives for IFSCs, I think Sripriya ji also mentioned that where a fund located outside India is relocated to IFSC, the capital gains from relocation were exempt, provided it happened before 31st March 23. Now it has been extended, and such capital gains will continue to be exempt if the relocation happens up to 31st March 25. Similarly, in IFSC banking units, when they earn an income, they pay the tax themselves, and further, if they make distributions to the overseas derivative instrument holders, again, they were being taxed. Now that anomaly is being removed of double taxation, the ODI holders will no longer be taxable, since the tax has already been paid by the IBU itself. For startups, again, India is one of the largest startup ecosystems, in fact, third largest in the world and extremely entrepreneurial. The startup ecosystem in India is extremely agile and vibrant. We are told that, again, the period of benefit for carry forward losses to be allowed without insisting on 51% shareholding continuance will now get extended to 10 years from the existing 7 years. and the profit-linked exemption available to new startups will be available even for startups which get incorporated up to March 24. Hitherto, it was expiring on 1st April 23, which is now extended by a year. Benefit or perquisites arising from carrying on of the business will now be taxed, even though they are monetary benefits, and withholding taxes will now apply. For thin capitalization provisions, typically interest deductibility was restricted to 30% of EBITDA, but there was a carve-out available for banks and insurance companies from this thin capitalization restricted allowability. Now we are told this carve-out will be extended even to NBFCs, which is a great step. So NBFCs will benefit without being hampered by thin capitalization interest deductibility restrictions. Income earned by non-residents from mutual funds will now qualify for even tax treaty rates benefits, while withholding can be done. So the withholding will be not merely at the domestic rate, but at the domestic rate or the treaty provisions, whichever is more beneficial to the taxpayer. The sovereign wealth funds and pension funds are now eligible to apply for withholding tax exemption, which is again a new provision. There are some procedural amendments as well, where transfer pricing documentation needs to be submitted now within 10 days instead of the earlier 30 days. Assessment time limit has been expanded to 12 months from 9 months. In case of reassessment proceeding, the minimum time of 3 months now needs to be allowed to a taxpayer for filing tax returns. And for hastening or speeding up the appeal process, small tax demand disputes can now be taken to the Joint Commissioner Appeals, which hopefully should considerably ease the pressure amongst Commissioner Appeals for quicker disposal of appeals and dispute resolution. With that, I hand it over to Uday to take us through the indirect tax proposals very quickly, and towards the end, both of us will be happy to take questions. Uday, over to you.
Thank you, Pranav, and all the dignitaries and participants. I'll quickly kind of talk about the key GST proposals, the indirect tax proposals. But before that, from an overall ecosystem, GST and the steps that the government took in the last couple of years has seen significant increase in compliances and has led to a material formalization of economy, which is consequently triggered, a robust tax collection growth. And all in all, I think should kind of also help in driving the future reforms on the indirect tax side. The indirect tax proposals in budget 23-24 continue to reflect continuity both on the rate policy and others, and we'll quickly cover those in the next few minutes. Pranav, the next slide. So one big change has been brought about is on the taxation of digital services by foreign service providers. It's taxed under this category called OIDAR, which is Online Information Database Access Retrieval. I'm going to call it OIDAR. Today, foreign digital service providers are liable to register and pay tax on any services provided to non-taxable resident entities. Two changes there, significantly expanding the ambit of this particular category. Today, the OIDAR services relate to services that are provided over the internet. The present definition suggests that any services to qualify as an OIDR needs to be essentially automated and involving minimal human intervention. Now, this particular category has been expanded by removing this phrase, essentially automated and involving minimal human intervention, And now several categories of services might now get covered, which are provided online, might get covered under OIDAR, which were hitherto being considered as having a human intervention and therefore not, therefore being excluded. At present, I mean, services could be tutorial services, education services, and the likes might be required to be relooked at. On the recipient side, earlier or right now, only services that are provided to unregistered persons, governments, local authorities, for purposes which were not commercial, were to be liable to be taxed. So purely individuals or services received which were not for commercial purposes were liable to tax in the hands of the foreign digital service providers. Now it's binary. I mean, a foreign digital service provider would need to pay tax when he's providing service to any person who's not registered. That's it, nothing more. Again, a lot of change that would need to be brought in for these foreign digital service providers. And we'll see what further clarifications come in on this behalf. Then next slide, Pranav. Pranav, next slide. So again, now e-com operators are allowed to, I mean, allow to have small traders who are working under a composition scheme to trade on e-com operators and pay GST. However, there are certain reporting and additional obligations that have been imposed on e-com operators. Again, a welcome change. This was a big ask from the e-com operators. There have been certain restrictions on the ITC related to corporate social responsibility expenses under a Companies Act. It is aligned with now the Income Tax Act. Certain other changes that have been brought about in relation to how to treat sales of from warehouses prior to clearances for home consumption, from prior to customs clearance. Again, this is primarily to kind of deal with taxation related to duty-free shops. So their supplies will be considered to be exempted, and there would be some amount of reversals of input tax credit that would be mandated given that. The government has gone ahead and made it provide clarity, suggesting that persons who are primarily and exclusively used in, I mean, providing exempt supplies or non-taxable supplies would not need to register. The implications are fairly wide and welcome at that. Pranav, next slide. On the decriminalization agenda, several changes have been brought about. To our mind, more needs to be done, but this is a great initiation. And again, this will get more certainty. They have significantly reduced avenues where prosecution can be considered, and that's good. The Goods and Services Tax Network portal is now authorized to share consent-based information to, other systems. Primarily, this is intended to enabling automated credit lending and financial inclusion. Great amendment brought in, and I think by this single amendment, a significant amount of change will be witnessed in credit lending and financial inclusion over the next few years. Next slide. I'll quickly cover the customs. Again, the duty rate policy has been consistent and has been targeted to increase economic activity within the country. Some minor changes related to auto and mobile phone entries. These are the basic customs duty rates or the basic tariff barrier has, over the years has been increased for some of the products where the government wants to kind of focus on increasing economic reliance, self-reliance. And I think they've continued with that policy. In the last few years, the government has been reviewing a significant number of exemptions. Around 750, 800 exemptions have been reviewed through crowdsourcing suggestions over the past few years. By and large, now that activity is done, and right now we expect the rate policy to continue to be stable. I think those were the broad changes. Over to you, Pranav, for the next.
Thank you so much, Uday. And hand it over back to Swapna, and then we can come back for the Q&A.
Sure. Thank you, Mr. Pranav, Mr. Uday. That was a very robust presentation, and I guess lots of materials to digest. So yeah, we will quickly move to Q&A. But before that, I wanted to request Dr. Ravi Kota, Minister Economic from Embassy of India, Washington DC, to kindly say a few words to our participants and talk regarding the opportunities. Thank you.
Thank you, Swapna, and greetings to everyone who are in India and also attending from US. So I don't want to take much time because most of the important issues related to union budget have already been covered, and some of the highlights were also given in the opening remarks by our ambassador Sripriya Ranganathan, Deputy Chief of Mission. But broadly, if I have to quickly summarize some of the things, like the three areas where the current budget has focused, like economic growth, job creation, and fiscal stability. And especially this comes in the given background of poly crisis and global economic downturn. And generally every year, every quarter, sometimes even less, even with more frequency, we get the ratings of general economic outlook of each country and major economies. And always you see a bit of differences in their outlooks. But especially now, what you see unanimously, there is a positive outlook of Indian economy as a bright spot. So with this kind of a contradiction in the, like at a global level, negativity and a lot of positivity within the country. So at that point of time, the current budget came with such a vision, and also the specifics. Some of them have been covered in the presentation today also, for building such a tech-driven, knowledge-based economy and robust financial sector with slew of ease of doing business related issues, and some of them very innovative and futuristic kind of a thing, like national data governance policy and other things. So, and one point I would like to highlight, in fact, it came out in the presentation also, but at the cost of repetition, that CapEx, sometimes we see only the numbers given by the union budget, but that's why in the budget this time they have highlighted about the effective CapEx, because a lot of support for the CapEx given by Government of India through the states. Also, we need to take that one, and the overall capital, public capital expenditure, how it is going to leverage the private capital, a crowd in the private capital is something very substantial. And exports also, I agree with some of the analysts who say that Indian export market segment, if you see the kind of a commodities we are exporting, relatively, they are agnostic to overall global trade kind of current outlook. WTO gave an outlook of a big downturn in the overall exports in the globe. But from Indian side, there would be challenges, but far better placed than many other economies. So lastly, if you ask me what are the 5 areas or 4 areas where you think that US-India kind of a corridor has a great attraction or traction for this budget. So based on my interactions with the different stakeholders in the market and US government in DC and USA, I would like to highlight 5 areas. One is that infrastructure. And as we talked about the capital infrastructure boost available in the system and how the connectivity, logistics, urban cities, green energy areas it's covering. In fact, last time in the India Energy Week, the Prime Minister's speech, if you had followed, you would see that the range of the green energy areas in renewables, green hydrogen, energy storage, ethanol, biofuel. Ethanol, very aggressive targets of E20 for 2025, 20% blending. So green mobility and green credit and all these things you see together, the whatever every word in the budget speech has a great relevance to the economy, and so many things are simultaneously happening. That is number one, infrastructure side. Second one is the digital economy. Everyone knows about the kind of advances made by India in this area, but the kind of center of excellences the budget talked about in artificial intelligence, as it was mentioned by our Deputy Chief of Mission, US-India recently agreed to have that ICET initiative for critical and emerging technologies. So all these things will fall together, and as a very robust kind of partnerships can be created, because national priorities and our US-India bilateral priorities are also aligning very fast. So then the third area is the enormous energy of MSME sector, and Mr. Uday Pimprikar highlighted about formalization of economy. You see, I mean, there's so many things are happening with the digitalization, but I personally saw how, because I was representing one of the state government during that transition from VAT to GST. There is a state's finance minister's empowered committee with the state government representatives. So that was the committee which was looking at even draft various kind of acts of GST, CGST, and all those things were prepared. So we see, or when finance minister were talking, the political kind of a concerns that no MSME, everyone is forced to register under the GST. So that's something that there was always, that informal versus formal. There are some benefits to be informal outside of the system. But when that formal piece is getting into the informal piece is getting into the formal kind of a system, there are a lot of apprehensions. There is a feeling of getting harassed by the tax authorities, etc. But all those things now, over a period of 5 to 6 years, you see the kind of energy getting unleashed. MSME, it's a win-win. Even MSME also getting leveraged by the digital revolution, the fintech benefits in linking them to institutional finance. That is something very substantial. So that is so that's going to open up into more startups, unicorns, and also a lot of SME business between US and India can find a kind of a big connection there. Then the fourth one is health, pharma, and life sciences. Like it includes the now budget has the present provisions for the health skills and the medical devices manufacturing, pharma innovation. All these areas, of course, US and India has tremendous kind of partnerships, and then B2B kind of attractions are substantial. Then last one, of course, international financial markets, how they can get better and more opportunities in India through GIFT IFSC is something has been extensively covered in the opening remarks of our Deputy Chief of Mission, and also during the presentations by Mr. Pranav. I don't want to further highlight on that, but these are the 5 areas where perhaps we can work more and have deeper relations. And there are large number of areas where we have win-win opportunities for both US and India in advancing our economies, and also creating more jobs in respective countries. So thank you so much, FICCI, and also ICAI Washington DC chapter for joining our embassy, for organizing this post-budget session. And we can, depending on the interest and the kind of areas, if anyone would approach any of 3 of us, we would be very happy to take this engagement further, and formally or informally we can have sessions to discuss on specific issues. so that any kind of a constructive feedback we can give back to Government of India in our ministries. So we'll be very happy to do that. And we are always available from the Indian Mission in Washington, DC, and all our 5 consulates across US to be in touch with you and take that your valuable feedback and suggestions back into the system for further consideration. Thank you so much.
Thank you, Dr. Kota. That was very interesting, and thank you for sharing the 5 important sectors where industry sees lots of opportunities and potential for collaboration. And FICCI, we're very happy to work with the Indian Mission for this. Thank you. So just moving ahead with our last part of our discussion today. So the first question that I have with me is from Paridhi Jain. Her question is, India tax laws impose restrictions by creating a permanent establishment if US businesses wanted to hire employees in India. PE, once established, puts a hardship on US business, especially startups and small businesses in many ways. What could be the possible solution to it? Solving this can open the door for employment opportunities in India directly from the US. Mr. Pranav, Mr. Uday, any one of you would like to take up the question?
Yeah, sure. No, thank you. Thank you so much, Swapna, and thank you, Dr. Kota, as well as Sripriya ji. Thank you, Paridhi, for that question. It's a real great question. The concept of permanent establishment is there under most treaties. So it is not unique to India's treaties, certainly not unique to India's treaty with the US. In fact, all of US treaties, I think mostly all of them would likely have this particular clause. And so also the India-US treaty. Yes, it does sometimes create a hardship for small companies. But what we've observed is the better thing in such cases to do might be to have an appropriate structure in place, maybe through a separate entity in India. And there are several de minimis and safe harbor provisions from a transfer pricing standpoint. So rather than create a permanent establishment of the overseas entity, one could consider probably having a subsidiary or an LLP in India, which is a separate entity, rather than engaging employees in the name of the overseas entity. And that may ease it a little. I do not think that currently the government would be looking at contracting or restricting the applicability of permanent establishment, because this is just such a general concept for all the India treaties, which were with virtually every country. And not just the India treaties, but as I said, most of the treaties, tax treaties that countries have across the world have this concept. The thing, however, is that it's only profits attributable to the permanent establishment that, if at all, get taxed. And probably, as I said, the better thing to do may be to solve it through having a small entity, even if it is not a company, but maybe an LLP, which is a partnership. In India, in which case the overseas entity then would not be subject to any permanent establishment, etc. exposures in India typically. Hope that helps answer the question. Yes, Swapna.
Thank you, Mr. Pranav, for very thoughtfully answering the question. So I now pass it over to my colleague and our partner ICAI for organizing this seminar, Mr. Praveen Jain. So would you like to take up the next question?
Yeah, sure. Thank you. So the next question is from Maneet. He asking is, making inward and outward remittance from end to India still seems a difficult task. Many things are left open at the discretion of the banker, where various bankers have a different stand on the same regulation. What can be done to make these processes more transparent and standardized?
Right. Okay. Thank you. Again, a great question. Very practical indeed. So over one, I'll put it into 2-3 different buckets. One, India has significant exchange control regulations. We are not a capital convertible currency, so to say, and therefore the Foreign Exchange Management Act is very much in place, unlike maybe US and many of the other mature developed markets, which have much more deeper currency markets as well. So unfortunately, we do have exchange controls. But what I may say is that for most things today, there are very clear and streamlined rules for making outward remittances. And for inward remittances, it should be even simpler in most cases. There are some authorized dealers who have far greater experience in dealing with some of these remittance issues. And some authorized dealers are probably not, and even some authorized dealers, certain branches are not as familiar with them. The RBI, the Reserve Bank of India, which regulates or really is the authority which regulates the exchange control, has delegated or has really simplified things by authorizing the banks or the authorized dealers to do most of it. So they are slowly moving towards liberalizing and improving the ease of doing business gradually. Yes, it's not that it is completely free of exchange controls yet. India probably is not still ready for it, but a lot of liberalization and simplification on this front has been tried. Most things now are delegated, and authorized dealers, the bankers themselves can take the call. I think in our experience has been that if we go to the right authorized dealer and the right team there, which has familiarity and experience with handling these matters, it becomes much easier and quicker. Yeah.
Thank you. Mr. Pranav. So we now move to the next question. It is from Shrishti. Our question is, India is making a significant step towards technological advancements, creating centers of excellence for AI or introducing a national data governance policy. However, there still seem missing appropriate security concerns among professionals handling sensitive financial and personal data. Can implementing strict laws like suspension of memberships or similar things help make this ecosystem robust? It is also crucial regarding the trust US people can put it in India.
Yes, that's something I think that the government has also probably been working on. And I guess we'll see some more of it in days to come. I think there's a question also from Mr. Ravi Mistry, which probably has been missed in between. I don't know.
Okay. Please go ahead, sir. Go ahead answering it.
I think his question is, I have a quick question.
Hello?
Yep, sorry. One second, I have lost that question again, but I just saw it. Yeah. I have a quick question outside of the budget, if that's okay. Do US citizens need to pay capital gains in India during sale of Indian shares? Yes, they do. If there are sale of Indian shares and there's capital gain, US citizens do need to pay tax in India. That is because unlike most other treaties, so first, under the Indian domestic law, even a non-resident selling an Indian asset is subject to capital gains. And second, the India-US treaty, unlike many other treaties, do not protect US residents from Indian tax, because it says that India has the right to tax based on its domestic law any US resident or citizen in respect of capital gains earned in India. So India would be eligible or would be entitled to tax capital gain on sale of Indian shares even by US citizens. Your next question is there TDS on such capital gains? And if they issue tax residency certificate, do they still need to pay capital gains tax and TDS? Yes, they do, because the tax residency certificate will prove your residency in the US. But as I said, the US-India treaty essentially says that both countries will have the right to tax capital gains in accordance with their domestic laws. So India would still have the right to tax even if you prove your tax residency in the US by producing a tax residency certificate. The thing, however, that might help you is there are concessional tax rates for non-residents, and the Indian capital gains tax, whatever it is, normally ought to be creditable against your US taxes on that capital gain. So it should not be an incremental burden, I would feel, from your perspective. Also, if the capital gains are from any NRE or FCNR kind of monies, then there are specific benefits under the Indian domestic tax law as well. Hope that helps answer your question. And the specific facts might help showing what exactly would be the tax rate applicable and whether some of these benefits would be available.
Thank you. Thank you, Mr. Pranav. Praveerji, if you would like to, take the
Yeah,
question
we can
from
take the last.
Ritesh. Yeah, because
Yeah.
in the interest of time, this would be our last question. And then I request you to kindly share your concluding remarks after the question is being answered. Thank you.
Sure. Thank you. So the Ridesh is asking, the world is still seeing the Indian financial sector as heavily regulated, which result in a high compliance cost and slow decision-making processes. What are the possible ways to deal with this global issue India is facing?
Okay, I wouldn't claim that I'm an expert at financial sector regulation, to be very honest, but yes, India has been conservative and cautious in terms of having regulations on the financial sector. By and large, there have been very, very well-maintained stability and systemic risks have been very well managed. But I don't know whether you have anything specific in mind in regard to the financial sector regulation that you feel needs to be addressed, in which case we can, during one of our interactions, pick it up through our advocacy or representation. But I wouldn't be able to say which particular regulation you are particularly concerned about. But yes, India is a little conservative in ensuring that systemic risks are well managed in India, particularly in the financial sector.
Yeah, thank you. Very nicely answered all the questions, Pranayji. And concluding the session, thank you for joining us in our virtual webinar today. I hope that you found the session informative and engaging and gained valuable insight and knowledge from our speakers. I would like to extend my sincere gratitude to Ambassadors Sripriya Ranganathan and our speakers, Mr. Pranav Sayta and Uday Pimprikar, who have shared their immense expertise and valuable experience. I would also like to convey my special regards to Dr. Ravi Kota for bringing the Embassy of India, FICCI and ICAI Washington DC chapter together to organize this knowledgeable session and your brief speech about the budget. Undoubtedly, the Union Budget 23 presents a grand vision of Amrit Kal, an empowered and inclusive economy that is a technology-driven and knowledge-based with a robust financial sector. The G20 summit scheduled to take place in India in September 23 is expected to be one of the highest profile international gathering to the hosted by the country. We are excited for the wonderful opportunity that this will present us. As we bring this virtual webinar to a close, I encourage you, as mentioned by Mr. Kota, to continue conversation and keep the momentum going on. We are ICAI DC chapter and across the US and many other chapters are also very interested to participate on this type of webinar or seminars. Once again, thank you for participating and making this virtual webinar a success. I hope you are a wonderful day ahead and I look forward to connecting with you again soon. Thank you. Good night to Indian participants and have a nice day.